Is the stock market rally we're seeing the real deal or just a classic bear market trap? It's the question on every investor's mind right now. We've seen some green on the screen lately, and it feels good after the brutal start to the year. But before we all get carried away, we need to take a hard, honest look at what's really going on. I've been digging into the data, and I'm going to argue that this is a deceptive rally, and the underlying problems that caused the sell-off are very much still with us. Let's break it down. First, remember why the market tanked in the first place. There were three big catalysts. The first and most important was the Federal Reserve's hawkish pivot. They made it crystal clear they were going to fight inflation by hiking interest rates aggressively and shrinking their balance sheet. This quantitative tightening is like taking away the punch bowl from the party. Higher rates make borrowing more expensive for companies and consumers, slowing down the economy. Has the Fed backed off? Not at all. In fact, they've repeatedly said their top priority is taming inflation, even if it means causing some economic pain. The underlying pressure from monetary policy hasn't gone away. It's actually intensifying. The second reason for the sell-off was a string of terrible corporate earnings reports and weak forward guidance. Big names, especially in tech and retail, warned us that sales were slowing and costs were rising. They were seeing consumers pull back on spending. So, has that changed? The short answer is no. While some companies might beat heavily revised down expectations, the overall trend is not our friend. Inflation is still squeezing profit margins. Supply chain issues, while easing in some areas, are still a headache. And most importantly, many companies are still guiding for weaker growth in the coming quarters. This recent rally seems to be ignoring those warnings, pricing in a V-shaped recovery in profits that just doesn't seem likely given the circumstances. And that brings us to the third catalyst, weak economic data out of China. As the world's second largest economy and a manufacturing powerhouse, when China sneezes, the world catches a cold. Their strict zero-COVID policy led to massive lockdowns in major cities like Shanghai, crippling their economy and causing ripple effects across global supply chains. So, has China bounced back? Not really. While they've eased some lockdowns, the policy itself hasn't been abandoned. They're still facing a massive property market crisis, and consumer confidence is incredibly low. Any new outbreak could trigger more lockdowns. The uncertainty surrounding China's growth remains a huge drag on the global economy, and a true sustainable market recovery is tough to imagine without a healthy Chinese economy firing on all cylinders. So when you put it all together, the picture becomes much clearer. The three core problems that triggered the market downturn, a hawkish Fed, weak corporate fundamentals, and trouble in China, are all still very much present. Nothing has been fundamentally resolved. This rally feels more like a temporary sigh of relief. A short squeeze driven by overly pessimistic sentiment rather than a genuine shift in the underlying economic reality. These bear market rallies can be incredibly convincing and powerful. They suck you in and make you feel like you're missing out. But historically, they are traps. We saw several of them during the dot-com bust and the 2008 financial crisis. There are periods of hope that ultimately give way to new lows when the market realizes the fundamental problems haven't been solved. I'm not saying you should panic and sell everything, but it's crucial to be cautious and strategic. This is not the time for reckless speculation. This is a time for quality, for companies with strong balance sheets, real profits, and pricing power that can weather an economic storm. Don't let a few green weeks make you forget the major headwinds we are still facing. Stay disciplined, do your own research, and don't get caught up in the hype. This rally looks, feels, and smells like a classic bear market trap. Be smart, be safe, and protect your capital. Thanks so much for watching. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into the market. I'd love to hear your thoughts in the comments below. Do you think this rally is for real, or are you also skeptical? Let's discuss it. See you in the next video. Then January 27th, the bounce. But none of the three catalysts have been resolved. Inflation remains elevated, Fed cuts are off the table, earnings are being revised down, China's economy is slowing. So why did markets bounce? Because markets always bounce. This is where technical analysis becomes critical. The S&P fell from 6,100 on January 13th to 5,685 on January 24th, a 6.8% decline. That 5,685 level is the 200-day moving average, one of the most watched technical indicators. When price touches it, markets typically bounce. But in bear markets, the first test always bounces. Then markets retest, and the second test usually fails. In 2000, the Nasdaq first tested its 200-day moving average in July, bounced 18% over 4 weeks, then retested in September and crashed through, falling another 37%. In 2008, the S&P first tested in January, bounced 12% over 3 weeks, retested in March, and crashed through, falling another 45%. In 2022, the S&P first tested in February, bounced 11% over 5 weeks, retested in May and crashed through, falling another 18%. We just completed the first test January 24th. History suggests a bounce lasting 2 to 4 weeks, maybe into mid-February, then a retest. If that fails, the decline accelerates. Volume profile reveals who's controlling this market. During the 2 red weeks, average daily volume was 4.8 billion shares, 35% above the 50-day average. High volume on down days means institutional selling. During the bounce week, average volume was 3.2 billion shares, 15% below average. Low volume on up days means retail buying or short covering. This pattern, high volume down, low volume up, is a classic bear market signature. Institutions are selling, retail is buying. That's not sustainable. Market breadth measures participation. On January 27th, the S&P rose 2.8%, but only 62% of stocks closed higher. The Nasdaq rose 3.4%, but only 58% of stocks closed higher. The Russell 2000 rose 2.6%, but only 54% of small caps closed higher. Compare this to healthy rallies. October 2023 had 87% breadth. March 2024 had 82%. Strong rallies have 80% plus participation. This bounce has 60%, meaning it's driven by a handful of large cap stocks, primarily the Magnificent Seven. When they rally, the index rallies, even if most stocks don't. This is distribution disguised as recovery. Momentum divergence shows weakness. The relative strength index on January 24th hit 28, oversold. By January 27th, it reached only 52. In October 2023, RSI reached 68 within 3 weeks. In March 2024, it reached 64. Strong bounces carry momentum to overbought territory. This bounce stalled at neutral. That means the rally is running out of energy. All 4 technical indicators point to the same conclusion. This is a bear market rally off oversold conditions. The underlying structure is weak. Institutional positioning reveals who's buying and who's selling. The Commitment of Traders report from January 24th shows large speculators reduced net long positions in S&P 500 futures by 42,000 contracts, a 23% reduction. Commercial hedgers increased short positions by 38,000 contracts. This divergence is bearish. Options flow over January 20th, 27th shows put-to-call ratio averaged 1.18. For every 100 calls bought, 118 puts were bought. When broken down by dollar volume, 68% of put buying came from institutional-sized orders over $500,000, and 71% of call buying came from retail-sized orders under $50,000. Institutions are buying protection. Retail is chasing upside. Classic late-stage behavior. And institutions are buying far out of the money puts. It strikes 15-20% below current levels with March and June expirations. These aren't hedges. These are directional bets on significant downside. Corporate insider transactions show insiders at S&P 500 companies sold $18.2 billion in January and bought $1.4 billion. That's a 13-to-1 sell-buy ratio. Normal is 3-to-1. The sectors with highest insider selling are technology, financials, and healthcare, the exact sectors leading the market. When insiders sell aggressively, business conditions are weakening. All positioning data points to the same conclusion. Smart money is defensive. This bounce is retail-driven, not institutional accumulation. Without institutional buying, rallies don't sustain. The 3 catalysts that caused the sell-off haven't resolved. They've worsened. The January 29th FOMC meeting is in 2 days. Current expectations show 71% probability of holding steady, 17% probability of hiking, only 12% probability of cutting. Fed chair. Powell said January 22nd, "We are not yet confident inflation is durably returning to 2%. Recent data suggests more work remains." That's hawkish. The Fed won't cut soon. Earnings guidance continues weakening. Of 127 companies that have reported Q4, only 53% beat estimates versus a 65% historical average. Of 82 companies issuing Q1 guidance, 71% guided below expectations. Full year 2026 estimates started at 11% growth, now at 9.3%. If revisions continue, estimates could fall to 7 to 8% by late February. The S&P trades at 20.8 times forward earnings versus a 16.5 historical average. For current prices to hold with falling earnings estimates, the multiple must expand, but multiples are already elevated. Without Fed cuts or improved sentiment, if earnings fall, prices must follow. China announced January 25th, a surprise, $500 billion yuan liquidity injection, $70 billion. Emergency liquidity signals economic conditions are weaker than official data suggests. If China needs aggressive stimulus for 4.6% growth, consumer demand is weak, meaning demand for Western products is weak, meaning multinational earnings will be weak. Historical precedents show this pattern repeating. In 2000, the Nasdaq fell 34% by May, bounced 38% by September. Analysts declared the bottom was in. The bounce failed. The Nasdaq fell another 60% over 18 months. Characteristics: oversold bounce, light volume on up days, weak breadth, concentration in large cap tech, weakening earnings. Sound familiar? In 2008, the S&P fell 9.8% in January, bounced 12% from March through May. Analysts called it recovery. The bounce failed. The S&P fell another 45% over 9 months. Characteristics: oversold bounce, off support, lighter volume up, weak breadth, deteriorating economic data, same pattern. In 2022, the S&P fell 17% through mid-March, bounced 11% by early April. Analysts said the correction was over. The bounce failed. The S&P fell another 16% over 6 months. Characteristics: oversold bounce, light volume, weak breadth, ongoing Fed tightening. Bear markets have multiple rallies lasting 3 to 8 weeks, retracing 30 to 50% of the prior decline, driven by oversold conditions. They fail when macro conditions don't improve. The current bounce has retraced 23% in 1 week. If patterns hold, this could last 2 to 3 more weeks, potentially pushing the S&P to 5,150 or 6,000. But unless inflation falls, earnings improve, and China stabilizes, this bounce will fail. What does this mean for positioning? We're likely mid-rally that could last 2 to 4 more weeks. Markets could recover another 5 to 7%. The S&P could reach 6,000. This is when retail buys, believing the bottom is in. But sophisticated investors are distributing into strength. Risk-reward is asymmetric. Buying at 5,145 offers maybe 3 to 5% upside versus 15-25% downside. If the retest fails, you're risking $5 to make $1. Professional traders don't take that bet. They build cash, buy protection, and wait. After this bounce exhausts, probably mid-February, markets will retest 5,785. If they bounce on high volume with broad participation, maybe the correction is over. But if markets break below, it confirms a deeper bear market. Based on macro conditions, breakdown seems more probable. Sector positioning matters. Defensive sectors like consumer staples, utilities, and healthcare typically decline 30-40% less in bear markets. Growth sectors like technology and consumer discretionary fall 50-70% harder. If maintaining equity exposure, rotate to defense. Consider cash as a position. When stocks fall 30%, cash gains relative purchasing power. When markets reach attractive valuations, cash lets you deploy while others are forced to sell. Risk-reward is asymmetric. Buying at S&P 5,845 offers maybe 3 to 5% upside to the bounce top, versus 15-25% downside if the retest fails. Sophisticated investors don't take 4-to-1 risk-reward against them. They build cash, buy protection, and wait for better prices. Key dates over the next 90 days. January 29th, Fed meeting. If they signal openness to cuts, markets extend. If hawkish language persists, the rally ends. Watch Powell's PRESS conference. Phrases like data-dependent leave the door open. Rates staying elevated until inflation reaches 2%, closes it. February 7th, January employment report. Below 100,000, jobs signals recession risk. Above 200,000 gives the Fed justification to stay hawkish. Unemployment ticking from 4.1% to 4.3% or higher approaches. Somm rule recession trigger. February 14th, 28th, critical retest window. Watch S&P 5,000 cooks at 85. Multiple tests indicate weakening support. A break on high volume confirms the retest failed. Next support, 5,400, then 5,100, then 4,800. That's 18% downside from current levels. 3 scenarios with probabilities. Scenario 1, bullish, markets rally to 6,200. Fed signals Q2 cuts, earnings stabilize. China announces major stimulus. Probability, 20%. Requires multiple positive catalysts aligning simultaneously. Scenario 2, range-bound, markets bounce to 6,000, retest 5,685 holds, trade in range for months as investors await clarity. Neither bulls nor bears get what they want. Probability, 30%. Scenario 3, bearish, markets bounce to 5,950, retest 5,685 fails, break to 5,400 by March, then 5,100 by April, potential 4,800 by mid-2026. This requires Fed hawkishness, accelerating earnings revisions, or China deterioration. Probability, 50% based on historical patterns, current macro conditions, and defensive institutional positioning. When the most likely outcome is 15 to 25% downside, risk management becomes everything. This isn't about being bearish, it's about being probabilistic, and probabilities currently favor caution. Think about opportunity cost. Every dollar deployed now is unavailable when better opportunities emerge. If you buy at S&P 5,845 and the retest fails, you miss the chance to buy quality at 5,100. That's 15% better entry, which compounds dramatically over time. Warren Buffett said, "The stock market transfers money from the impatient to the patient. Right now, the impatient are buying this bounce. The patient are building cash, waiting for the retest to either confirm strength or create real bargains. Fear of missing out is powerful during bounces. Every up day makes you question your positioning. Social media fills with gain posts. Friends talk about recovering portfolios. The pressure to participate is intense, but discipline matters most here. Bear market rallies exist to trap late buyers. If you chase this rally and it fails at the retest, you've converted unrealized losses into realized losses. Better to endure FOMO and deploy when probabilities favor offense. What should you actually do? Not financial advice, but here's how institutions are thinking. First, reduce exposure during strength. If currently 80% equities, consider 50-60%. Use this bounce to lighten recovered positions. Second, liquidate weakest sectors. High valuation technology, consumer discretionary dependent on strong spending, financials with credit exposure. These typically lead markets lower. Third, maintain defensive exposure. Utilities, consumer staples, healthcare decline 30 to 40% less in bear phases. Fourth, build cash to 30-40% by mid-February. Money markets earn 5% now. That beats losing 20% in declining equities. Fifth, consider hedging if you can't reduce equity exposure. Long-dated S&P 500 puts, inverse ETFs, VIX calls provide downside protection. Sixth, maintain discipline around the retest. Watch for high volume bounce with broad participation versus breaking below on high volume. The next 90 days determine whether 2026 is consolidation or larger bear market. January was the warning. This bounce is the false signal. The retest is the revelation. Wall Street recovered after 2 red weeks, but recovery isn't reversal. Recovery is technical. Reversal is structural. This looks technical, not fundamental improvement. The choice is about timing and risk management, when to play offense, when to defend. Right now, timing says wait. Risk reward says defend. Historical patterns say this rally will likely fail. If this gave you a framework, that's what matters. Not certainty, but probabilities. Not predictions, but patterns. The retest will tell us everything. If it holds, maybe the correction is over. If it fails, the real decline begins. Position now determines whether you preserve capital or give it back. The next 2 months aren't about making money. They're about not losing it. And sometimes, not losing is how you win.